Well, hi everyone, and welcome to this week's edition of Feeling Smarter. As always, I'm joined by my co-host Tim Miller. G'day, Tim. How are you?
Yeah, going pretty well, Aaron. How are you doing?
Not too bad, thank you. Well, this week is an interesting one, to say the least, because we have now seen the revised. We weren't meant to see revised, according to the Treasurer, but we have now seen the revised view of the government around the operation of Division 296 tax. The writing had probably been on the wall, it would be fair to say, Tim, over the past few weeks as the media was speculating that the Prime Minister's office had started to take a much greater interest in the way in which the operation of those original Division 296 tax measures were going. And naturally, a number of concerns had been flagged from not only industry, but then back to the Labor backbenchers, which had a number of concerns as well. It's been top of news for the best part of 2.5 years, I think it is now. So it was February 2023 when we saw this announcement, and we went through an entire election cycle where, in essence, it was defeated by virtue of a single block of crossbench senators holding Labor up in terms of the concerns that were flagged predominantly around the unrealised capital gains and lack of indexation. So here we are today, Tim. This week we have seen the Treasurer announce changes, which I'm assuming will form part of the MyFO, so the mid-year economic update with revised numbers. But what I might get you to do is to just give us an explanation of what these changes are around the operation of this additional tax for high balance superannuation account holders.
Yeah, that's a big introduction there, Aaron. And I think the first comment that I will say is the unconsultable has become consultable. I'm not even sure if consultable is a word, but it is for today's video. Yeah, look, it's interesting. And of course, we are currently without legislation. So this is based on the announcement piece, but the government are wishing to proceed with the introduction of Div 296. Importantly, and first and foremost, with a pushback of the start date to 1 July 2026, as opposed to what we all felt was highly
Unreasonable
problematic.
now.
Was 1 July 2025. Yep. So the first lot of assessments won't occur till after 2027, or during the 27-28 year. So that's the first thing. The second announcement was that the $3 million will be indexed, and because the $3 million is based on what I can assume 1.5 times the general transfer balance cap, it will be indexed in a line with that in $150,000 increments. So the transfer balance cap with $100,000 increments and the general transfer balance cap by $150,000 increments. So that's a positive there. But in addition to that, the introduction of a higher high balance cap of $10 million, which will have an indexation of $500,000 apply, which because it's 5 times the general transfer balance cap. And so the new measure is that the existing additional 15% tax liability will apply with those with balances between 3 million and 10 million, and then a further 10%, so taking it up to 40% tax liability in total for those on their earnings greater than 10 million, with balances of greater than 10 million. But of course, the big news to come out of it is that the government are intending to base it now on earnings being realised earnings, as opposed to what was always the industry's almost really only bugbear. Like we could tolerate to a degree the non-indexation piece. We wanted indexation, but it was always the fact that the whole Div 296 was based on unrealised gains, and now there will be a move away from that, and it will be based on realised earnings inside superannuation.
Yeah, so a couple of things that naturally stand out there for our audience to understand. As you said, we will see a simplified approach to determining that calculation. So actual earnings, which for SMSFs is relatively straightforward from within your accounting software. Granted, there are some debits and credits that we don't know and understand around that, which we'll get to that shortly. I can see you biting your lip there for a second.
I will say, Aaron, that I love your optimism, where you say that we will have a simplified approach to the earnings calculation, and I too do hope for that. But I find it quite interesting the way they've written it anyhow today, with the back and forth between the funds and the tax office to start with. But yeah.
Yeah, so I think for self-managed super funds, the ability to undertake that calculation might actually end up being much simpler than in APRAland, which will have a number of systems and so forth. And we'll get to some of the differences around insurance proceeds and the labelling that needs to be done. But conceptually, there will be a fair and reasonable allocation that will need to be determined and applied to the member, in essence, in accordance with SIS regulation 5.03. So, and ultimately there, the tax office will use its resources where appropriate, where people try to utilise circumstances that are not consistent with the allocations under that fair and reasonable approach. The other thing there is the fact that we end up with these two thresholds. Now, from my point of view here, the important bit to remember with the tiered thresholds and therefore tiered taxation rate is not to necessarily, again, get caught up in the headline. And the headline is, 15% at the fund level, and then it becomes 30, then it becomes 40. Because as we know, this tax is a member-related tax, whereas the first 15%, and to some extent, the first 2 million can be in an exempt environment. So therefore, it is 15% at the fund level, and then a further 15 or potentially 25% at the member level, insofar then that the member, if they choose to do so, can then release that from the super fund or ultimately pay it. So the conversations that we've been having historically here are still relevant, because yes, there's a headline figure here around 30 and around 40%, but that's not necessarily the case.
Yeah, and I think, and that was an area that we'd certainly covered before, as had others, was that it was never a 30% tax. It was always a 15% individual tax on what potentially was anywhere between 0 and 15% fund tax liability as well, and that doesn't change. And so even the concept of being taxed on unrealized gains, it was more the concept around using unrealized gains to determine what your balance was, where we know, well, that's just a paper number as opposed to a real number until you actually realize it. So yeah, the headline is 15% tax for individuals, right, on their earnings if they have more than $3 million in super. It's actually got nothing to do with the super fund whatsoever. That's just the tool to determine your number.
Yeah, and the other thing, Tim, is at the moment it's kind of we've taken ourselves back to February 2023, because we've gone back to the fact sheet, which is in essence what happened at that point in time in the middle of Feb, when this was announced by the Prime Minister and Treasurer at that point. And we will again go through a period of consultation to work out some of the mechanics. But fundamentally, it appears that the operation of how the liability will operate will predominantly be the same as what it was historically, i.e. the liability to the member, the ability to release, the way in which the ATO's role will be in utilising TSB to determine it, and the index, well, I'll come back to indexation in a second, but the threshold and process and arguably probably timeframes and stuff will all very much look the same.
Yeah, and I think that's important. And I think what is obviously important for us to keep our eye on is things such as the proposed amendments to total superannuation balance previously, that they flow through this change, but also from what I gather, as you say, the calculations of the proportion of earnings above $3 million, those sorts of things will still apply. And so again, even when we talk about a headline act of 15%, it's not 15%, it's 15% on a portion of those earnings, because a portion of those earnings belong to the balance below 3 million.
Yeah, and you did touch on before, and I think it's just worth looking at again. We are going to see alignment here of the indexation to the transfer balance cap. So when we see the transfer balance cap, like we did with the concessional caps, the concessional caps ultimately link themselves to a WATI, and then we see the transfer balance cap link itself to CPI, and then we see that 100,000 increment. What we're then going to see again is alignment of the $3 million cap back to the TBC, as you said, at 150% in essence. And then we have a 5 times multiple in essence with that $10 million threshold. So we're not going to see any inconsistencies there to determine the inflationary effect, and therefore more numbers that we need to deal with linked to TSB and transfer balance cap. But ultimately, we can see the flow on effect of what those numbers will provide.
Well, that's right. And look, Aaron, I mean, I know that next week you and I are going to speak about the finalisation of the NALI ruling. The government finally got their 5 times factor into a piece of legislation. So, well, we haven't got through there yet, but yeah, that's there'll be consistency across all of that.
Yeah, absolutely. So where to from here? So, we've seen the government naturally sort of reset, and now we will go into a period of consultation. From my understanding, they will be looking to introduce this measure into Parliament as a bill, probably in the early sittings of 2026, and therefore giving a sufficient level of time ultimately through to allow for this to be introduced and effective from the 1st of July 2026, as had been indicated originally. What are your thoughts in terms of what people should start to be thinking about, revisiting and the like, and really the identification of those clients that are impacted and what happens next?
Yeah, well, I think to me, one of the things that jumps out straight away is clearly there's no rush to get in and sell assets, because the sooner you sell assets, the sooner you're potentially liable for tax on the earnings on those. And so, the whole ECPI bit has a lot to play with in the sense of the funds tax liability. But, keeping larger gain-based assets, for a longer period of time, whilst you're potentially selling down lower assets or whatever, could end up being beneficial. And I think you mentioned to me in our conversation last night about this, that there could, will this give light to or give rise to another CGT reset approach? And, I think, in speculating about that sort of stuff, probably you'd think no, not like the general transfer balance cap introduction, all those sorts of things there. But, they're all part of the consultation. And I think for me, particularly being involved in that original consultation, is there's still some key issues around things like TPD and other benefits, where there was ultimately inequality between TPD versus structured settlement and things like that with reference, because and again, another ruling that we're going to talk about in a future video about the contribution ruling and the treatment of insurance proceeds. They're very clear that insurance proceeds themselves largely are not contributions, but a profitable gain to the fund. So that leads a pathway towards insurance being incorporated into something like Div 296, but will there be potential carve-outs? That'll be the consultation piece that I have interest in, to see where that sort of stuff goes.
Yes, and the other part to this announcement was, of course, the realignment of the low-income super tax offset. And if you read all of the publications by the Federal Treasurer, you wouldn't know that Division 296 was changing, because it was all about providing more for Australians that were on lower incomes. But ultimately what we've got here, Tim, is just a simple realignment to the changes that we've seen over the past few years in respect to the increase around SG, and then alignment to the stage 3 tax cuts, which also, funnily enough, were never changing, but we did see the Labor government change.
Yeah, and look, and I think I remember us sort of working through this at the time, particularly when those stage 3 tax cuts came in, and we talked about the drop down from 19 to 16%, but then the increase of the threshold. We said, well, that's all well and good, but those that are most impacted here are those who earn just above what was the previous $37,000, because they're still going to be paying basically the same flat rate of tax inside super versus outside of super. And there really wasn't any sort of give or take at that point in time. We said, well, really this measure needs to be aligned with the new threshold of 45,000, and it needs to take into consideration the rise in super guarantee. And it's only taken 5 years. I mean, let's that's a short term in some instances, but it's
quicker than getting gnarly result. Put it that way.
That's right. It's a positive measure to get that, because there are a lot of people that are impacted. It's mandatory. They get their super guarantee, but they're going, well, hang on, I'm paying the same amount of tax inside super as I am outside, and so the listo certainly benefits them there.
Yeah, absolutely. And there's a level of cynicism in me that says that this all lines up in 1 July 2027 start date with the listo, which also coincides when we'll probably go through our next cycle of an election as well. So anyway, I won't go any further there, but we know how politics works. Well, once again, Tim, thank you for your time. Naturally, we're going to be spending a lot of time following this with great interest, and no doubt, Tim, this is going to be a key feature of our SMSF Day events, which we'll be holding in March 2026, right around Australia too. So thank you once again.
Always a pleasure.
Thanks, everyone. Have a great rest of the week. Bye for now.
Bye.